Hi, welcome back. To this my third update on my data from 2021. In my last post, I looked at equity markets and bond markets, and we spent a lot of time talking about the financial asset markets. But when you have a year like 2020, and you have gyrations in equity and bond markets, trust me, every other market is impacted. In this session, I want to talk about the other markets that I did not talk about in my last one: commodities, currencies, collectibles, and look at how they did in 2020. Along the way, I don't think there's a choice that I have than to talk about Bitcoin. After a year like Bitcoin had last year, how can you leave it in the dust? So I'm going to talk about cryptos, what they did in 2020, and what the lessons we might take out of it are for the future. So let's start with the classification of investments. Now, this is a personal classification. You could disagree with me, but I find this classification useful in thinking about what I can and cannot do with different kinds of investments. When I look at an investment, I put it into one of four buckets and sometimes more than one. Let me explain. An asset has expected cash flows. A stock is an asset, a bond is an asset, buying a piece of a business is an asset, a rental property in real estate is an asset. They have expected cash flows. A commodity derives its value from being an input into a process that produces goods and services that people like. Oil is a commodity. Iron ore is a commodity. Copper is a commodity. A currency serves three functions. First, it's a measure of value, a number you put in an item to tell people how much it costs. The second, it's a medium of exchange. It can be used to buy or sell goods and services. And third, it's a store of value. If you set aside money in a currency for the future, you still want it to be there. Good currencies deliver those functions better than bad currencies. And already you can see that just because a currency is a fiat currency, a currency issued by a government, doesn't make it a good currency. The Swiss franc might be a really good currency, but the Venezuelan bolivar, not so much. A collectibles pricing comes entirely from demand and supply. It's based on perception of how scarce an item is, and it's a function of the taste of individuals. A Picasso is worth millions because we've collectively decided that it's a fine work of art. If tomorrow we decided otherwise, its price would go to zero. And among collectibles, you can have a whole range from fine art to sports memorabilia to an item like gold. In fact, to see that there are some investments that might fall into multiple buckets, let's say gold. Gold is sometimes used as a commodity, right? It's used to make jewelry. It's used to make, and if you think about it, it's not just jewelry, it's electronics, gold wire. So it can be used as a commodity. It's been used as a currency off and on over human history. In fact, for a long time, even paper currency was connected to gold through the gold standard. And gold has also been a collectible, which is something people hold because they don't have trust or faith in institutions in a crisis. Gold can be a commodity, it can be a currency, it can be a collectible. But even though it serves all three purposes, there is always a dominant purpose. The reality is, gold's use as a commodity is tiny relative to its use as a collectible. There might be some parts of the world that still use gold coins, but it's not widely used as currency anymore. Today, gold is primarily a collectible that sometimes might serve as a currency and sometimes as a commodity. You think, who cares? To see who cares and why we should care, we introduce a different distinction. By now, you've seen this distinction that I've used in multiple sessions. So I hate to repeat myself. Actually, I love to, but I have to say that I do. No. But let me re-emphasize the difference between value and price. We know what drives value. Value is a function of cash flows adjusted for risk. So value of an asset is a function of the level of the cash flows, the growth in those cash flows, and the risk in those cash flows. Now, you might use an intrinsic valuation model to come up with the value, but the value is driven by those forces. Price is much simpler and more direct. It's a function of demand and supply. And that demand and supply can be a function of mood, momentum, what I call surface stories, small stories that might not mean very much but can still move the price, and liquidity. And to price something, you look at that item's history and perhaps other items just like it and what people are willing to pay for it. Hey, that's how we put a number on real estate, right? When you buy a house, you don't do an intrinsic valuation of a house, you price the house based on what similar houses have sold for. See, what's this got to do with the classification? If to value something you need expected cash flows, only assets can be valued. You can value a stock, you can value a bond, you can value a business, you can value rental property. It's true, you can also price assets. You can price a stock by looking at other stocks, seeing what they trade for, perhaps using a price-earnings ratio. Assets can be valued in price. You can get a rough value for a commodity based on macro demand and macro supply. So you could look at how much oil people will demand collectively and look at the oil supply and come up with a value. But the reality is, when you try to look at oil, you price oil. You price it relative to its history, price it relative to its alternatives. Currencies and collectibles cannot be valued. We re-emphasize that. Currencies and collectibles cannot be valued. You cannot value the dollar. You cannot value a Picasso. You say, but people put numbers on them. Yes, they do. They price them. Currencies are priced against each other. That's what we call an exchange rate. Currencies that have greater acceptance, are better measures of value, better stores of value, will have higher prices relative to currencies that don't have those characteristics. Collectibles are priced based on scarcity, how much people want them, and I want to emphasize longevity. When you put your money in a collectible, you don't want it to be a Beanie Baby or a Pokemon card. Items that people paid lots of money for 20 years ago but are worth nothing now, you want it to hold its value. So assets can be valued and priced. Commodities are mostly priced. Currencies and collectibles can only be priced. You're still saying, so what? When I think about being in markets, I think about playing one of two games. You can play the trading game or the investing game. You're saying, what are you talking about? In the trading game, here's what you do. You buy at a low price, you sell at a high price. Why did the price go up? You really don't care. To be a good trader, you have to have a good gauge of mood and momentum, as well as the capacity to get out before the momentum shifts. So if you look at traders, they will look for tools that allow them to gauge mood and momentum. I know we look down our noses at technical analysis and charts, but guess what? If you're a trader, that might be your most useful tool. And to be a good trader, you got to have many of the characteristics that would make you a good gambler. You've got to be able to forget your mistakes, be quick acting, and good instincts. As opposed to investing. In investing, you try to attach a value to an asset. Try. You know you're making assumptions. The assumption could be wrong. You try to assess a value. And if the price is less than the value, then you buy the investment and hope that the price moves to value. Hope. You might not be able to force it. Now, how do you value an investment? Well, you can use intrinsic valuation tools, discounted cash flow valuation, fundamental research. But your skill set then has to be a valuation, and second, faith in markets correcting their mistakes. In each case, there are other things you can bring to the table that can improve your odds of success. If you're a trader, it'll be nice if you have the capacity to drive momentum. And investing, it'll be nice if you can be the catalyst that causes price to move to value. But in my view, there's a lot of delusion in markets out there. For traders, the ultimate delusion is to act like you're basing your decisions on value. Why? Because it sounds better. For investing, the ultimate delusion is that you can reason with markets and talk prices down. So with that set up, let's talk about what commodities, currencies, collectibles, and cryptos did during 2020. Let me start with commodities and let me focus on two commodities that I tracked on a week by week basis in real time through 2020: oil and copper. Why did I pick those two? They're both economically sensitive. So, given that we had a global shutdown in 2020, you should expect volatility. And you did see that. In fact, between February 14th and March 20th, which was the peak period for the crisis, if you remember, that was the period where stocks melted down. Commodities melted down as well. Copper was down almost 50, if you look at the price drop between 214 and 323, almost 19%. It's just over 19% actually. But oil was down more than 50%. Brent crude, which is global oil, was down 59%, and West Texas crude 55%. Clearly there's something else going on in the oil market that goes beyond COVID and a global shutdown. Now, both commodities came back over the course of the rest of the year. Copper came back fully. In fact, by the end of the year, by the end of 2020, copper was up 26% over the course of the year. Oil was still down, 24% in the case of Brent crude, 21% in the case of West Texas crude. But that was still a big comeback from the absolute base of this crisis. So clearly, 2020 had major implications for both oil and copper. In fact, there was a day, April 20th, where West Texas crude actually dropped below zero. I never thought I would see that happen. But basically, investors were panicking about storage capacity in the US, and you had to pay them to take oil off your hands. You see, that's just oil and copper. What about the rest of the commodities? Well, in this graph, I've looked at three broad commodity indices. They're all maintained by S&P. The first is basically a broad index of all commodity futures. GSCI is a version of the index of just liquid and tradable futures. Not all commodity futures are liquid and tradable. And then there's a subset that looks at only agricultural products like wheat and corn. And I looked at each of these indices through the year. The broad commodity indices are very similar to what you saw with oil and copper, which is they started the year with a slight drop, and then between February 14th and March 23rd, they went into free fall, and they spent the rest of the year climbing back from that abyss. Over the course of the year, though, broadly, commodities lost 6 to 10% value, depending on which index you use. But if you look at the agricultural product index, it was less affected by this crisis. And that's not surprising. I mean, the economy might have shut down, but our stomachs didn't. We still had to eat. Between February 14th and March 23rd, the peak of the crisis, they lost about 6% of the value, but over the course of the year, agricultural product futures went up 22%. Let's move on to currencies. I'm going to start by looking at the US dollar versus 6 currencies, 3 developed market currencies and 3 emerging market with quotes around the word emerging market currencies. So I looked at the euro, the pound, and the yen, and then the yuan, the Indian rupee, and the Brazilian real. Now, if you look at 5 of these 6 currencies over the course of the year, it wasn't a big movement here. In fact, if you look at the overall performance during the course of the year, the dollar lost value against the euro, the yen, and the yuan. It kind of held its own against the British pound and the Indian rupee within 2 or 3%. And it gained significant value against the Brazilian real. But between February 14th and March 23rd, remember those were the peak days of the crisis, the dollar gained against every single one of these currencies. Reflecting again that in periods of crisis, it's still the currency people want to hold. That could change in the future, but in 2020 it still had. Again, if you want to look at broader indices, I've looked at 2 broad indices here, both maintained on the Federal Reserve side. One against developed market currencies, the other against emerging market currencies. So this is the dollar versus developed market currencies, the dollar versus emerging market currencies. Again, looking across the year, the dollar lost 5.5% against developed market currencies, kind of stayed even against emerging market currencies. But focus on the crisis period. Between February 14th and March 23rd, the dollar gained 5% against developed market currencies, that flight to crisis, but it gained 12% against emerging market currencies. So if you'd invested in an emerging market company on February 14th, and those markets melted down, in addition to the meltdown, you'd have had an additional currency pain inflicted on you because of this. Now let's move on to precious metals. Let's focus on the two oldies but goodies, gold and silver. Gold's been around longer than fiat currencies. It's been a crisis asset of long standing. So my question was, hey, did it hold its own in 2020? Yes, roughly. Again, look at February 14th to March 23rd. That was the crisis period. Gold lost only 5% of its value. It lost value, but lost only 5% of its value, as opposed to stocks losing 30%, Bitcoin losing 40%, pretty much every single asset class melting down. And then it recovered over the course of the rest of the year. It was up 24% of the year. Silver actually dropped a lot more during the crisis period, but had an even better overall year. But measured as a crisis asset, gold was a much better investment than silver, because the definition of a crisis asset is when everything else is melting down, what does your price do? Now, what about collectibles? It's tough to tell. If you look at the fine art market, the number of transactions dropped off, but that's because markets for fine art are usually in physical spaces. You don't do it online. And because of the shutdown, that was more difficult. Online auctions did surge, but they couldn't make up for the loss of actual sales. You say, what happened to the prices of fine art? It's tough to tell. And here's what. When you have a year when fine art prices drop, you actually don't see a lot of transactions because owners pull their art off the auction block and wait for better times. Now, over the next few months, we'll learn more about what happened to prices. But my gut feeling is, given what we saw in the other markets, maybe there'd have been a drop between February 14th and March 20th. In other words, if you're trying to sell a Picasso on March 1st, you might have felt some pain. But by the end of the year, you'd be okay. Which brings me to cryptos. It's been a year, and that's all I can say for Bitcoin. And let's face it, Bitcoin has been given attention well in excess of its actual place in the global economy for the last 12 years. It's for a simple reason. It's had huge ups and huge downs. In fact, all you need to see why Bitcoin has the kind of attention that it does is look at what its price has done since 2013. Starts at almost nothing, ends 2020 at almost $30,000. And during 2020, it climbed stratospherically. Now, before we examine whether Bitcoin should be priced at $30,000, let me ask a more fundamental question. What the heck is Bitcoin? Is it an asset? Is it a commodity? Is it a currency? Or is it a collectible? You know what? Even among Bitcoin enthusiasts, there seems to be no consensus. I know I'm going to get a lot of backlash for what I'm going to say next. But here's what I see when I see Bitcoin. Bitcoin is not an asset. The pushback I often get is, you're seeing securities. There are actually securities that are being created out there that are denominated in Bitcoin. You can create a bond denominated in Bitcoin, but that doesn't make Bitcoin the asset. It's the bond that is the asset. It's denominated in Bitcoin for the same reasons that if you created a dollar bond, I'm not going to call it the dollar an asset. I'm going to call it the contractual claim that you've created, the bond, the asset. Bitcoin is not an asset. Is it a commodity? Well, I've heard people argue that it is, and they're basing it on the fact that it's built around blockchains. Blockchains are an innovation. They're being adopted in more and more parts of the economy. And the argument is as blockchain grows, Bitcoin grows as well. But I don't see the connection. Bitcoin does not have a proprietary claim on blockchain. You can have blockchain without Bitcoin. In fact, you can have it with other cryptos, you can have it with fiat currencies. Now, there are some cryptocurrencies that are designed specifically to make blockchains work better. Ethereum is a good example. There, you might be able to argue that there is a commodity argument. That is, the demand for blockchains increases because those blockchains will work better with Ethereum. That maybe the demand will go up as well. So it's not an asset. It's not a commodity, which leaves us with two choices. It's a currency or it's a collectible. I know Bitcoin is often described as a cryptocurrency. And in spite of all of the hype and all of the talk, it's not been a very good currency. And what I mean by that is remember those three things that currencies need to do. They need to be a measure of value, a medium of exchange, and a store of value. Bitcoin has not done well as a medium of exchange. I know, you're going to bring up that Microsoft accepts Bitcoin and Overstock, and Walmart. But let's face it, if you look at how many transactions are done in Bitcoin 12 years after it came into being, it stayed unacceptably low. And there are reasons. I think there are three reasons why Bitcoin has not done better as a currency. The first is it is an inefficient currency. In other words, when you want to get a transaction okayed through Bitcoin, the amount of time and cost it takes to confirm a transaction is just too high. I don't want to buy a cappuccino at Starbucks and wait for a Ukrainian miner to confirm that the transaction goes through. It is an inefficient currency. Second, what makes Bitcoin so attractive to traders and speculators? This huge volatility. It can be up 25% a day, down 25% a day, works against it as a currency. Let me ask you a question. Even if you're a believer in Bitcoin, would you want to use Bitcoin to pay for something today? You know why you wouldn't do it? Because you're worried it could go up 25%, in which case you've left 25% of the table. So buyers don't want to use Bitcoin because it could go up, and sellers don't accept it because it could be down 15 minutes after they take it. And thirdly, I know one of Bitcoin's selling points is there's a limit on how many Bitcoins can be out there. That was built into the design at the start. But a currency with a fixed limit is not a healthy currency. And here's why. Let's say Bitcoin gets accepted widely and economies keep growing. If you have a limit on the currency and economies keep growing, you have a deflationary currency. You're saying, so what? Economies with deflation have all kinds of side costs that make it difficult to sustain those economies. I know, there is this argument that Bitcoin is the currency in dark domains. You know the stories of the Silk Road and how people use Bitcoin to buy drugs and other products that were illegal. Let's hope that's not the story for Bitcoin. Because if your argument for Bitcoin is the niche currency for transactions that are illegal, you already created a smaller market. And second, you put a target on your back for every regulator for the rest of eternity. So right now, Bitcoin is not a good currency. The other argument I've heard is it's millennial gold. It's a collectible. That you're investing in Bitcoin because you have no faith. No faith in central banks, no faith in governments, no faith in fiat currencies. Okay, I hear that. But for it to be a collectible, you got to show me that it has staying power. I know it has a limited quantity. That's a good thing in a collectible, to have scarcity. But that is true only if you think Bitcoin cannot be replaced. There are no substitutes. If other cryptos are substitutes, even if they're not close substitutes, then there is no limit to how many can be produced. And the second is, unlike gold, where you might actually like what's made out of gold, that jewelry looks really good, the shinies of the metal, Bitcoin is in virtual space. You know why people like Bitcoin? It's desirable. It comes entirely from the fact that it's made so much money for so many people over the last decade. That is a very dangerous basis for desirability. Because what happens if Bitcoin stagnates or goes down for 5 years? If your only selling point has been, hey, we made a lot of money, and that unfortunately is the selling point that many people who promote Bitcoin give you, you've built a very shallow basis for longevity. So with that basis, let's look at 2020 and see what it tells us about Bitcoin and where to put it in this continuum from asset all the way to collectible. 2020 overall was a great year for Bitcoin. It was up 303%. Ethereum had an even better year, up 469%. You think this is good? The crisis year did well. Well, not so fast. Remember, 2020 was a strange year. The overall year was actually good for stocks, good for bonds, good for most investments. The trying period was between February 14th and March 23rd. You saw how gold behaved, one of the few investments that kind of held its own. The question I had going into this crisis was, will Bitcoin behave like gold? Will it hold its value as people lose faith in markets, governments, and currencies? And at least in 2020, it didn't hold its own. Between February 14th and March 23rd, Bitcoin lost 38% of its value, Ethereum lost 52%. It's true they made it all back by the end of the year. But if you measure Bitcoin as a crisis asset and Ethereum as a crisis asset, neither behave like a crisis asset. In fact, they both behave like very risky stocks. I'm not trying to talk you into or talk you out of Bitcoin. I'm saying if you're trading Bitcoin, and you cannot invest in Bitcoin because it's not an asset, you're trading Bitcoin, at least be clear about what the end game is. Because I think the end game is still kind of hazy. I'm not saying Bitcoin is going to collapse in the next 6 months. I have no idea. It could go up, it could go down. And here's the reason I wouldn't mess with shorting Bitcoin or trying to get smarter than the market. Even though the pricing might have unmoored itself from reality. After all, nothing fundamental happened in the second half of 2020 that will lead you to believe that Bitcoin should go up as much as it does. For pricing momentum to break, there's got to be a surprise, something that tells people you're being unrealistic. And with Bitcoin, I don't see what form that surprise would take, at least in the near term. And that's because we don't even know what the end game is. There are no markers that we're measuring Bitcoin against, saying, hey, they didn't do as well as I expected. I think that this is by design. Bitcoin is the way it is because the people who trade Bitcoin want it to stay kind of in a hazy unknown. Because that serves their purpose. As long as this is hazy, they can keep saying, well, it's whatever you want it to be. Put simply, if you're a believer in Bitcoin being the currency of the future, you know who you should be fighting? Not me and other skeptics. It's those Bitcoin traders who want to keep Bitcoin a speculative play rather than a currency or a collectible. So what did I learn by looking across these markets? I remember when I took my first investment class, we spent, I think, 2 sessions on the importance of diversification. Common sense argument saying, look, you can't put all your eggs in one basket. You got to spread your bets. And I was told to, at the time that I took those classes, and I'm giving away my age by telling you what I was told. I was told that I should invest in foreign stocks, in real estate, because those markets were not going to move with stocks, and basically they were going to bring, or with domestic stocks, they would bring my risk down. We all learned that lesson and perhaps learned it too well. So you know what we started to do in the 1990s and beyond is we started to put our money in foreign stocks. We started to securitize real estate investment. And in the process, we create an unwanted but predictable consequence. As we all got more diversified, the correlation, the co-movement across markets went up. It became more difficult to diversify. It's one of the ironies. We did what we were told to do to diversify, but in the process, we reduced the effectiveness of that diversification. And in 2008, you saw this play out, right? During that crisis, you realized that there was no safe place, that everything you had was either going up or going down at the same time. So I was curious about what 2020 brought. Now, don't be intimidated by all the numbers on this. This is just a very simple correlation matrix across multiple asset classes. So let me explain what I see in this graph. But remember, the way you read correlation, it goes from +1 to -1. +1 means you have two things or two asset classes or two investments that move together in perfect harmony. That's +1. -1 is two investments that move in perfect disharmony. When one is up, the other is down exactly proportionately. +1 to -1. So let's see what this table tells us. And I want to focus in on just the first column now under the S&P 500 because it kind of summarizes much I want to say. I have four equity indices, the S&P 500, which is large cap US stocks, the S&P 600, which is small cap US stocks. But I also have the Euro 350, which is European stocks, and an emerging market index that S&P has about emerging market equities. Notice that they all are positively correlated. They move together. It is true, emerging market equities are a little less correlated than European equities. But if all you have are equities invested across the globe, during the crisis, you felt the pain everywhere. Now, if you bring in T-bills and T-bonds, you notice an interesting phenomenon, and this might be 2020 specific. Now, the way I computed returns on a daily basis for T-bills and T-bonds is T-bills, I just took the rate, nothing changes. But T-bonds, the price can change. Put simply, if interest rates go up, the price of the bond goes down. And what you saw in 2020 was interesting. And normally when I tell you what will happen to stock price if interest rates go up, you say, well, stock prices go down. That wasn't the case in 2020. During 2020, stock prices went up when interest rates went up. Stock prices went down when at least in general. The way this shows up is you look at the correlation with the T-bond, it's -0.48, which means when bond prices drop, which happens when interest rates go up, stock prices are higher. Now, if you look at corporate bonds, the co-movement becomes positive again. In other words, when stock prices were up, corporate bond prices were up. And they were up more for lower grade bonds. High yield bonds were behaving a lot like equities. The correlation was higher. Commodities were moving with stocks as well. Oil, copper, the broad indices. Now look at the US dollar. The relationship between the dollar and stocks was actually negative. As stocks did well, the dollar became weaker. As stocks did badly, the dollar became stronger. Again, at least in 2020. Gold and silver were hedges, but not big hedges. I mean, the correlation is not negative, but it's a very low positive number. And finally, look at Bitcoin and Ethereum. You see the message I delivered in the earlier chart, which is they're behaving like equities. They move a lot with stocks. Now, you could pick any pair of asset classes and find the correlation here. But I'm not trying to tell you that you should go out and hold every piece of this, but I'm arguing that diversification today is a lot more difficult than it was 40 years ago. Because things move together. So 2020 delivered some very important lessons for us that I hope we can bring into how we invest going forward. But there are things specific to 2020 that hopefully we will leave behind. I hope you found the session useful, and I thank you very much for listening.